We put out some estimates yesterday from the Budget Lab at Yale where we took stock of essentially where we are inclusive of this new Japan framework and concluded that effective tariff rates, if they were to go into place at the levels that have already been stated for the deals that have been reached, are going to be at over 20% as of August 1st. And so that's a pretty substantial difference relative to the 2.5% when President Trump took office. The result of that is we expect to see prices increase for households on an average of about $2,700 per household. And those increases are going to be concentrated in particular industries where the tariffs really have the greatest bite, right? So they're going to be a 35% increase in apparel prices or a 12% increase in consumer electronic prices. And I think, and to sort of pair off on some of the discussion you were just having, part of the reason you're not seeing that yet to that magnitude in the data has to do with the fact that in a lot of these industries, apparel is a good example, what happened in the lead up to these Liberation Day tariffs was an understanding that the president was going to shift up these rates very substantially. So inventories rose really dramatically. People tried to bring in a lot at lower tariff rates with the cognizance that high tariffs were going to come. So I suspect we're going to start to see some of these price increases over the course of the months ahead. And indeed, if you look into the CPI, you're starting to see a little bit of that already.
It's really interesting when you combine the impact of front running, as you're suggesting, with maybe a reluctance, at least in the beginning, for companies to pass along higher prices. They're trying to absorb this within their profit margins to the extent that they can. This is really interesting, though. You put such a fine point on this, $2,700 more in costs for 2025. Is this then all backloaded to the second half of the year or the fourth quarter? When does it hit?
Well, it's interesting. It's sort of hard to predict exactly what these are. Sort of our estimates are based on trade models that provide the capacity to do that kind of granularity. But of course, it's kind of hard to predict with every twist and turn of this. And ultimately, it's hard to anticipate where exactly these tariff rates are going to land because, of course, you know, Howard Lutnick has said August 1st, it's a hard deadline, but the president has also said countries should feel free to come and continue to talk to us after that date. So in some sense, like, timing this and understanding how businesses are going to respond and how consumers are going to respond is like a hard thing to do because it's difficult to know exactly like what the environment is going to be just a few weeks from now, let alone what the environment is going to be a year from now. But one thing I think is like really interesting and important about some of these impacts is that they're going to ultimately have a lot to do with how the Federal Reserve responds to the increases in tariff rates that we've seen over the course of the first 7 months of the administration, because these price effects could show up in the form of price increases as inflation rises and prices rise, or if the Federal Reserve doesn't look through these tariffs, they could also show up through a decrease in nominal income. So in some sense, we're in like a bit of wait and see.
Natasha, I also want to ask you about growth outlook, something that the administration is very focused on. Your report finds that U.S. real GDP growth over 2025 is 0.8 percentage points lower from all 2025 tariffs. In the long run, you write the U.S. economy is persistently 0.4% smaller, the equivalent of $135 billion annually in 2024. Put this into perspective for us. Just how much is this when we are looking at bigger growth targets from this White House? They say will come with their policies.
Well, what's important to appreciate, and we've talked about before, is like a way to understand the tariffs essentially is that they're a form of a tax. And so taxes, not in all circumstances, but in many circumstances, tend to have distortionary effects and can impact economic activity. What the tariffs are doing is they're shifting activity into sectors of the economy that are less productive than other sectors of the economy where America really has its utmost strength. And so the result of that is going to be a persistently smaller economy, both because we've done this sort of inefficient shifting into particular sectors, but also because we've raised prices, we've lowered demand, we've decreased the incentive for businesses to invest and grow. And so all that is going to come with really substantial economic effects in the medium run and also in the long run, because these aren't tariff rates that are going to kick in just for a short period of time. The idea, at least that some in the administration have articulated, is these are revenue raisers that are going to raise $2.5 trillion over the course of the next decade.
Love your take on the job market here, because you ran numbers on this as well. Remembering this is part of the promise of tariffs, the idea of reshoring businesses, bringing jobs back. You say the unemployment rate would go up by about a half percentage point this year, and payrolls could be almost 600,000 positions lower. What about tariffs bringing jobs home?
You know, it's so interesting because this is also sort of like sector specific in some sense. So as you're trying to reshore in manufacturing in particular in ways that are kind of frankly quite difficult to do in the short to medium run. So some of this has been, we want Apple to be making iPhones in the US. Like, they actually physically do not have the production capacity to do anything like that. But let's say even that they did. The result of bringing some of those jobs in is going to be some of these broader economic trends that we've discussed, which is that prices are going to go up and people are going to consume less and demand is going to be lower. So in other sectors of the economy, there's actually going to be less demand for employment and less demand for business investment, such that in aggregate, you're going to see employment at lower levels, even if in particularly favored sectors, you manage to get a little bit of an employment boost. But even that's hard to do because these manufacturing jobs, they use intermediaries like steel and aluminum, so prices are rising on those as well.
Right. Just quickly in our last minute here, can you actually speak about the impacts from the sector-specific tariffs like steel, like aluminum? We're talking about car makers, automakers, and how that's phasing in to the picture here, because those tariffs are enacted on a totally separate legal basis from the so-called reciprocal tariffs, yet they still make their way into all of these discussions that we're talking about for the overall tariff rates for our trading partners.
Yeah, and it's so interesting. At some point, it would be so great to talk through some of the legal dynamics here, because we're kind of on questionable legal footing for a lot of the tariffs that we've described, because in theory, they're supposed to be associated with emergency moments, and it's hard to argue that there's any such exigency at this point. But for some of those sector-specific tariffs, I've thought it's kind of complicated to make the argument for them. If you're trying to say that we need to do more car manufacturing in the US, more of the Fords, more of the GMs, well, they're actually very heavily hit by some of those sector-specific tariffs because 60% of car parts are actually imported into the US. And so there's a bit of a puzzle with respect to how you aim to accomplish some of these goals and even boost manufacturing, as the administration claims they're trying to do, if what you're actually doing is making it harder to do some of that manufacturing because you're making it more expensive in these particular industries.